your neighbor who doesn't like you is not going to be lobbing, Fallout 4 style warheads over your fence anytime soon. There's a huge amounts of stipulatory components that go into taking custody of any kind of yellow cake, tokenized or not. But of course, they're playing by all the rules. For every, let's say, 80 tokenization projects that are potentially selling you a tokenized bridge, which may or may not be underwater already, there are 20 that are doing some very solid, compliant, by the book work, because it is a very heavy lift.
Welcome to the Building Web3 podcast. I have my good friend Ray here. He's an expert on real world assets. Ray, could you give us a brief introduction to yourself and what were you doing before you entered Web3?
Well, hello, Jax. It's fantastic to be here. Thanks so much for having me. I am Ray. I'm the head of research at RWA World. We are a premier real-world asset intelligence company, and we kind of break down the broader brushstrokes of what are tokenized real-world assets and bring some context and some information as to what that all means. What I was doing before, tokenizing, contextualizing the tokenization of real-world assets, a number of things. So in a past life, I was a bank auditor, which was a lot of fun, and it's a bit like watching paint dry, but like somehow marginally more boring than that, believe it or not. I had a little stint where I tokenized some carbon credits. That was super interesting, and that began my foray into interpolating physical assets into digital ledgers. I've poked around with blockchain since 2014, knew of Bitcoin's existence, kind of messed around with it, thought it was super interesting, but always saw them as kind of self-contained ecosystems. So when I realized that sustainability assets could be ultimately fractionalized, tracked more readily, ultimately higher fidelity, with a definitive layer of assurance behind it, that kind of opened up an entire new world. And then I started plinkoing my way down into what is now RWA World. So now we have much more than sustainability assets. Of course, that's one of our categories in our taxonomy. But suffice it to say, there's anything and everything that can and is making its way on chain. So that's a little bit of what I was doing and what I'm doing now.
Oh, very cool. So could you give us a bit of an overview of the project and what the general mission is?
Yeah, absolutely. So RWA World, as I mentioned, is a real-world asset tokenization intelligence company, first and foremost. So what we're doing is we're really demystifying tokenized real-world assets. From a long arc perspective, we're in day one of real-world asset tokenization. We've seen a lot of blockbuster headlines with treasury bills specifically making their way on-chain. Some real estate assets have begun to wiggle their way into the mix. But ultimately, everything is making its way on-chain, from watches. I mentioned sustainability assets. That really got its start in 2021, roughly. Some folk were working on it well before that, some real trailblazers. But suffice it to say, these are apples to oranges. And when we were starting to look at this a bit more intensely, we realized that, hey, you can't really compare tokenized real estate and the qualities that are imbued to it when it is tokenized with something like a treasury bill. We saw really early on there were some of these comparisons being made, some of these apples to oranges, to pears, to grapes, to papayas examples being thrown around all over the media and what have you. And naturally, that's totally fine and natural. It's a very exciting time. But we really quickly caught on to the fact that there's some deeper discernment to be had here. There's a bit more contextualization. And as we started to peel back the layers, we realized, okay, we thought it was a bit more contextualization. It's a lot more contextualization. And there's a lot of 0 to 1 educational content, conversations, all sorts of things in between that need to occur in order to prime the wider audience for understanding what this all means. Kind of like when I first started poking around with Bitcoin and blockchain back in 2014, people kind of understood, okay, it's like digital gold, it's digital money, interesting. I've had around 6 or 7 Thanksgivings now with my father-in-law, slowly working on him to understand what all this could mean and what all this is. And we're starting to make some progress. But really what I found super interesting was, hey, when I mentioned treasury bills, because he's a financially minded gentleman, it clicked for him. He said, oh, okay, so it's just an easier way to track this existing financial product. And I said, aha, we have something here. If we can have a 0 to 1 moment for tokenized assets, then really we have a 0 to 1 moment for blockchain and DLT, the underlying technology writ large. It's kind of a sneaky, not even a sneaky, but really just a psychological backdoor to understanding the technology with a bit more of a real world example. So real world assets lead to real world examples. That's a little bit of what we're doing at RWA World. A lot more going on behind the scenes. We have a proprietary taxonomy. of now 13 different categories, everything from sustainability assets to public debt to real estate, and all the sub assets you would expect. So when we're talking about public debt, we have, of course, treasuries. We also have municipal bonds, and that allows for a bit more of an apples to apples comparison, maybe even a crab apples to crab apples comparison when you get down in the sub taxonomies. And that's really made a lot of the difference in terms of hoping to push forward that conversation about tokenization.
Absolutely. So we're talking about tokenization, and I think many of the audience are obviously going to be very into cryptocurrencies, but they might be like, tokenization, what is that? What does that mean for real world assets? So what does really tokenization mean at its core, and why is it important to bring real world assets on chain?
Oh, absolutely. And that's a fantastic question. Normally, I use my father-in-law as an example. I've been having the opposite conversation with people outside of the industry, and it's a fantastic inquiry. So tokenization at its core means taking a exogenous asset, something that's outside of a blockchain system, something different from Ethereum, which lives on the blockchain natively, or Bitcoin, which does the same thing, and parallelizing its ledger. So naturally, if we have real estate property, which many people do, or at least they rent from a company that owns a real estate property, that is recorded on a ledger, generally at a bank, or maybe you have your old style book that you're writing down things. I don't think many people do that anymore, but I take notes in one. Something about pen and paper just changes the game. But ultimately, if I lose that book or it gets wet, I drop some water on it, and a couple of lines in the ledger, they become augmented or unreadable. That's a big problem. That's what makes Excel sheets so exciting and fantastic, is you can send them a lot more quickly. They don't weigh anything. But if someone can hack into the bank, these shadowy supercoders, you can call them, that's kind of how I think of blockchain developers, right? They just whisper magical runes into the computer using their fingers and keyboards. If they can augment these kind of ledgers, that's a challenge. That's a problem. So tokenization at its core is leveraging blockchain's immutability, its transparency, and its trustless nature to parallelize the existing ledgers for physical assets into distributed ledger technology and all the benefits that entails. It can help to increase liquidity, not intrinsically, but in many cases, it helps to increase market access through fractionalization. You can maybe buy 1/100th of a transformer, but if it's not tokenized, that means you're kind of buying a broken piece of a transformer. Who wants to really do that? So it adds a lot of these qualities and benefits that, of course, we can get into. But that's really what tokenization is at its core. Just to sum it up, taking something physical, creating a parallel ledger on a blockchain.
Yeah, and I think the example that most people will be familiar with, and they're probably already using real world assets, they just don't see them that way, is stablecoins. So could you describe how stablecoins are actually real world assets and how that underlying minting process works?
Yeah, absolutely. So there was a huge kind of conspiratorial component going on when I first got involved with stablecoins that, Tether's not backed by anything. It's going to explode. All of crypto is going to come crashing down. And of course, I poked a little bit with that rabbit hole, but found relatively quickly that it gets out of the realm of reality and into the realm of tinfoil hats and the reading of tarot cards and tea leaves reasonably quickly. Nowadays, things are much more above board. Tether is a fully backed institution, albeit it's not based in the United States jurisdiction. It's very closely related. And Circle, for example, they have a one-to-one backing. For every one stable coin they mint, they have to have $1 in their bank account or something equivalent. So, for example, a treasury bill or something that pays a yield. Now with yields up around 5% at the time of recording, that's a pretty good deal for the actual issuer of the stable coin. So when you go and you, let's say, sell your Bitcoin, and you don't want to have to go and take this out to a bank account and then do another wire transfer, pay the fee. You have to explain to the nice person, if you're in the United States, at the desk, oh yes, I'm going to wire this money and buy Bitcoin. And they look at you like you have two heads and call the compliance department. Stablecoins are a fantastic tool for that. And ultimately, if you're using USDC, USDT, or any of the blue chip stablecoins, you are very much using a real world asset on the back end, because those stablecoins are backed up by real physical US dollars or treasury bills or dollar equivalent assets that are pristine and backed by the full faith and credit of the United States government. So you're entirely correct that stablecoins are really right now the de facto, due to their burgeoning market cap relative to the rest of tokenized assets, the actual de facto real world asset for the time being. And they're definitely the most of interest to state actors at this time. And they're liquid, they're fast, and they're a heck of a lot more efficient and expensive than a wire transfer, that's for sure.
Yeah, it's pretty crazy. I was just having to send some money between my regular bank account and my business bank account. And I'm like, 3 to 5 days for an ACH transfer. This is horrible. So
Absolutely.
Let's talk a little bit about the specific sectors and industries that you think will benefit the most from this asset tokenization.
For sure. And of course, the one of the most exciting ones that has attracted the most interest initially is treasury bills, bonds, anything in between in terms of the duration, simply because with yields so high, they actually pay a bit more of a coupon than some even DeFi lending. So in terms of our little nick of the woods, our small area of the financial world that we call DeFi, tokenized treasury bills have become very attractive. But really, tokenization has huge implications for industries that ultimately are maybe not even financial products. I made the joke about buying a broken transformer, but what's super exciting about the ability to collocate collectibles, which is something I get really excited about using tokenization, is the fact that there's a what would you call them? Like a collectible shop in town, basically a nerd store, as I call it. They have anything from Magic the Gathering cards to these old Transformers that I mentioned. And I'm actually reasonably close with the people who run it, had some great conversations, and there's all kinds of interesting market particularities about these collectible assets. So, for example, Pokemon cards, we all, around my age, people grew up with them. Maybe you did as well, Jax. We know them, we love them. What's really interesting about these cards is that they retain a reasonably solid amount of their value because people see them, they recognize them, they love them. They say, oh, it's Pikachu, oh, it's Charizard, of course. And there's a bit of resellability there. It's completely the antithesis of Magic the Gathering cards. About 90% of Magic the Gathering cards that are purchased are used for actual play in what's called the meta. So when a new generation of cards come out, then if that card is defunct and no longer usable in play, its market value drops off very precipitously. And so there's these market dynamics that are at play in the collectibles market that are really only extant in those little kind of stratas of their own self-contained world. And speculation is very isolated to these kind of collectibles communities. But now, as we've seen with NFTs, there's a latent interest in collectible assets that are fundamentally digital. And as we've seen for years and years and years, again, talking about Pokemon, there's already been a very clear market demand for collectibles that are physical. But naturally, I'm not going to my collectible shop down the road every day to check on the local price of Pokemon cards. I'm not going to this single website that grades these things to get a general discernment of a particular card. And there's all kinds of qualities that can augment the value of these cards. But as we see these things tokenized, we begin to get more comparisons. Someone in South Dakota maybe has a similar card to one here in North Carolina compared to one down in Colombia. And what that means is that we can actually see the total liquidity available for these certain collectibles, whatever they may be. I'm just using cards as an example. This could be anything from old bicycles to Transformers to board games, even old 1950s kitchenware, for example. Fun fact, very colored plates from the pre-1930s. Actually, I believe it's around 1939, there was a cutoff. They are highly radioactive. They actually use uranium to paint these things, and they have a nice little collectible value to them. So there's the ability to have price discovery and add liquidity, or at least a sense of liquidity and market homogeneity to markets that otherwise don't have that whatsoever. And we can talk about the uranium market specifically, which there's some really interesting things going on with tokenization there. It's a really powerful thing to me. So I think collectibles and just generally heterogeneous assets that you can compare, but people aren't quite doing yet, are going to be the ones that benefit the most from tokenization.
Yeah, and I think this is a very interesting concept for people because they may understand like, hey, treasury bills on chain, or hey, dollars on chain, but they're like, hey, if I get a house or a car, how does that work? How are they actually committed to transferring the assets? So can we talk a little bit about how these more physical assets are going to work on chain?
Yeah, absolutely. So my long running joke now is like, hey, don't lose your seed phrase and don't lose your wallet, because then you can lose your house, right? And that's no good, because if someone hacks your account, congratulations, you got to move out of your house. That is not how it works. Absolutely not. Ultimately, how this works is just like you have in the traditional real estate world. You have your deed. What happens is these deeds can become tokenized. Your actual proportional amount of ownership can become tokenized and brought on chain. And what this does is it allows you as the homeowner to, let's say, for example, using a company like Lofty, they're a great example, fantastic company based here in the US. You can ultimately get something akin to like a HELOC if you list your home. So for those who may not be aware, HELOC is a home equity line of credit, and you can access the underlying equity in your home. And ultimately, instead of having that parsed out through a middleman like a bank, and then parsed out to wherever that ends up in the back of the bank's plumbing, you're actually having a bit of a peer-to-peer, or in this case, a peer-to-peer-to-peer-to-peer-to-peer, because it's a liquidity pool relationship. And what that means is less middlemen means a better rate for the HELOC issuer and, of course, the actual borrower themselves. So it's similar to like a liquidity pool that we saw in DeFi. Morpho is a great example. What they do is they're a type of technology that lives on top of a like compounded Aave liquidity pool, and they do peer-to-peer connections that actually circumvent the liquidity pool, but use that liquidity pool as base rate as the minimum rate that the borrower has to pay and that the lender will receive, or vice versa. So suffice to say, we're seeing a bit of this kind of DeFi magic be interpolated into real world lending, which is incredibly exciting. So that's a bit how it works with real estate. And naturally, folks like Lofty have a much more nuanced understanding, a much more nuanced kind of interplay between how this can ultimately work, because we're at the very early stages of this sort of thing. And we're just seeing it evolve in a really nascent, compliant way, naturally. Trying to get some kind of regulatory clarity on Bitcoin or Ethereum. Now going to talk to them about, hey, what about a on-chain HELOC? We kind of have a little bit of time before we end up at that level of clarity, at least here in the United States.
Yeah, it raises a very interesting point. Is real world assets are really coming to the forefront now and still relatively nascent. So what are some of the technological advancements that we've made that's allowed this to be possible?
Absolutely. So realistically, this sort of thing was achievable, feasible, pretty much since the advent of smart contracts. I'd like to give a small shout out to Block Apps. They are founded by Kieran Lubin, who's actually the son of Joe Lubin, who is the CEO of Consensus. They've been working on compliant tokenization since 2015. So this thing's been going on for a while. For Talo as well, when they found out that, hey, we're trying to tokenize some assets, some financial assets, they realized that the rails weren't exactly there. Don't know if they talked to Block Apps or not. That's not my wheelhouse, but suffice to say, they went ahead and founded Vertalo to make this sort of thing happen. So realistically, while the technology was there, it was very much a bespoke process. If you wanted to get a HELOC on chain, naturally you have to identify people who would want to loan you the capital on the other side. You have to explain to them how the blockchain rails work. You'd have to ultimately ensure the sort of thing was compliant. So many of these boxes needed to be ticked. And ultimately, there was not enough of the social gravity for this to catch on. It's like trying to, let's say, sell cars in the 19 teens. That's something that was happening for sure. And there was some fantastic technology there. But it wasn't really until Henry Ford knocked it out of the park with his production line and automation where we really started to reach the mass market. And now, after a number of cycles, Mt. Gox scared the bejesus out of everyone way back in the day. 2017 happened, the ICO boom, not so compliant, and then the NFT thing blew up. Finally, we're getting to a point in terms of technological maturation, which really the technology itself was mature, but the social perception of that technology's maturation that's starting to make all the difference to where we're seeing these assets being interpolated on-chain in volumes. And not least because this is the first time in 15 plus years, we actually have rates that are above 2%, 0% in many cases. So that was a huge driver as well. DeFi rates being lower than traditional rates. I mean, the degens are going to find their rates somewhere. So tokenization was inevitable for those bonds.
Can we talk about some of the benefits that tokenization brings? Because some people might be like, house on the blockchain, diamonds on the blockchain. Why does this matter? What is the real important benefits that tokenization brings?
Absolutely. So one of the biggest ones that I like to reference first and foremost is fractionalization. And what that means is you can take something, I'll use the collectibles market again because the easiest to understand, and you can break that thing up. Let's say a Charizard card. Somewhere out there is a holographic Charizard. It's not first edition, but it's my holographic Charizard, and I don't know where it is. It should have been in my parents' act, but it's not. So somewhere out there, Ray's Charizard is floating around. And if I wanted to sell this Charizard, I could go and do that at the shop that I mentioned up the road from my house. But ultimately, I would have to relinquish that asset. What I could do with tokenization is I can tokenize it and fractionalize that asset into, for example, 100 pieces. And that adds a little bit of a financial spice to it. Because if, for example, in the stipulations, you have to own 100 out of 100 shares to take physical custody, then so long as I retain one of those shares, then ultimately I retain some kind of underlying exposure to that asset itself. Now, That doesn't mean I can run back into the vault and grab my Charizard from the custodian, but it does mean I have at least a piece of the original asset. And this ultimately financializes the product in a way that's a little bit different than just buying and holding the entirety of the asset itself. For example, if I am a collector and I want the total upside exposure, or I want to put the Charizard card in my Pokemon deck, I can go out and buy the card and do so. But if I just want the exposure, then I can buy, let's say, a 99 out of 100 or whatever percentage of these shares, and ultimately each share is going to be cheaper. If the total value of the card is $100, we split it to 100 shares, I only have $5. Well, let's assume 0 transaction fees, I can have every these shares. That's fantastic. So now I can have exposure where previously I was locked out of the market. And what that does is that can increase ultimately the liquidity, but not intrinsically. That's an important thing. A lot of folks say tokenization increases the liquidity of an asset. There's a bit of a risk there, because what it can do is that it can also increase market fragmentation. And what that means is if you have, let's say, a number of companies all tokenizing Rolexes or all tokenizing Pokemon cards, you need to make sure that these systems can talk to each other, because if not, well, then we end up with a system where I have 99 out of 100 of this Charizard, but someone else has 50 out of 100 over there and 33 out of 100 over there. And it ultimately makes the process a lot more fragmented and illiquid. And that's what we've seen pretty much in every early market. The price of gold close to a gold mine in the year 1400 is going to be much lower than the price of gold far out afield, where gold is a very highly sought after commodity and a luxury good. So to use a historical example, that's why during the early days of colonization and contact with the New World, you hear these stories about, they were able to trade huge chunks of land for beads, because when those particular beads were seen as incredibly valuable and rare and very far afield and difficult to obtain. So you have this kind of relative value matrix there. So kind of circling back and threading it back to the main point in your question there is that, of course, we have fractionalization, we have access, and in many cases we have increased liquidity, but we're not quite at increased liquidity in many subsets of tokenization markets yet. We're seeing kind of fragmentation of liquidity, but that can then ultimately be solved with the passage of time, formalization, etc. I would say those are the biggest benefits of tokenization, along with instant settlement. That one kind of goes without saying. Here in the financial world, many folk are familiar with T1, T2, T3. That means the day of purchase plus 1 day, 2 days, 3 days. Talking about stable coins and wire transfers, you had to wait however many days to have that money clear. That's not preferable. We'd like to have things instantaneously. So the ability to have that ledger settled immediately is very, very nice, very cushy, and something that I think people in our age range kind of take for granted until we actually have to go into the bank and talk to somebody on the other side of the desk and realize, 10 days. All right, I'll see you in 2 weeks, I suppose.
Yeah, let's also go into interoperability, because there's liquidity fragmentation, there's different kinds of blockchains. Are there going to be some blockchains that are more conducive to real world assets, or how are these blockchains going to interact with one another?
Yeah, absolutely. And that's a fantastic question. We're kind of seeing the early emergence of a multi-chain, omni-chain kind of future that we've all been hoping and praying for. Fragmentation in blockchains is something that we kind of just see intrinsic now. You have the Ethereum virtual machine or EVM compatible chains. You have Cosmos's IBC. And these don't intrinsically talk to one another. And to your point, there's emerging networks that are evolving and then showing up that are explicitly designed to support the tokenization of real-world assets. In terms of EVM-compatible layer 2 networks that are built on top of Ethereum, Plume is a great example. We also have the XDC network. They're one of the 4 blockchains that are supported by Securitized specifically, and they have a special flair in trade finance, which I always find fascinating. I'm a huge tokenization nerd, if you can't tell, so trade finance, of course, tickles my fancy. And then, of course, one of the ones that I think is the most undersung currently is the Provenance blockchain. And they were completely missed in the Masari report. They have over, I think it's $13 or $14 billion now worth of tokenized assets on their chain. They have Franklin Templeton as one of their 64 validators. Of course, Ethereum has, I think it's over 100,000, or no, it's 1.3 million now validators in Ethereum 2.0. But for many of these financial assets, really 64 validators is leagues and worlds better than what we have now. In the traditional financial industry, you have things like dark pools where you just have JP Morgan, BlackRock, and Citibank, and a couple of others just talking to each other behind closed doors to sell these equities in ways that the retail market has no idea is happening. So the fact that you have 64 validators on a public chain like Provenance is a huge improvement overall. And all three of those examples, Plume, XDC, Provenance, those are all dedicated networks for tokenizing physical real-world assets, or at least financial assets that we can consider exogenous to existing blockchain systems.
Yeah, it's a very, very interesting system. So some people that are more financially minded might be asking themselves, what is the difference between a derivative, the financial instrument, and a real world asset? Because derivatives, as we know, track their underlying price from the underlying asset. So where's the difference between these two?
Yeah, fantastic question. So a derivative instrument, as you mentioned, is a derivative. So you're tracking the kind of underlying price, but not the fundamental underlying asset. Tokenization, if I can say the thing my company's based on, tokenization itself is the actual tracking of the asset itself. So for physical assets like a collectible, then you'll have the transformer custodied in a Swiss vault somewhere, or maybe a vault in Ohio. It doesn't have to be in Switzerland. And with a tokenized treasury bill, for example, a company, a fund really, is going to procure that bill, and then ultimately they're going to tokenize the underlying bill itself. And then you're able to purchase and get direct exposure to that asset. And so while tokenization can very easily and very readily enable derivative instruments from that tokenized asset. So for example, let's say we have a tokenized transformer. I want to speculate on it. I can go ahead and issue a token that tracks that underlying tokenized transformer's underlying value. And ultimately what that can do is that can help to increase price discovery and those sorts of things surrounding that asset. But the actual core tokenized asset itself is indeed backed by that asset. Of course, terms and conditions apply. Check your local lawyer. I am not one of those. But suffice to say, there is a bit of a difference between the derivatives that you would see in a traditional financial market and the actual underlying tokenized assets that you'd see from interpolating a physical item or a financial product into a blockchain ledger, because it's really just a parallelization of the existing ledger for that asset, or really, I guess, the parallelization of the transformer held in a nice glass case somewhere.
So can you share some success stories or case studies where real world assets have started to make a significant impact?
Yeah, absolutely. Definitely stablecoins, the asset class that you referenced previously, they've had a huge, fantastic impact on the financial system already. The OCC, the Office of the Comptroller of the Currency here in the United States, back in 2019, I believe, may have been 2020, watch it'll be 2021 or something. They ultimately said, regardless of when they said it, that stablecoins are permissible for wire transfers. So we're seeing the slow groundwork being laid there. Now, naturally, with Operation Choke Point 2.0, things have started to get a little dicey there. But nevertheless, stablecoins are now on parity with Visa in terms of transaction volumes. Visa themselves either way released a fantastic tool to track stablecoin volumes that cuts out any kind of wash trading or arbitrage. So they have some really, really accurate, high fidelity data for stablecoin volumes. So it's of interest even to existing incumbents. Additionally, as I mentioned, with rates being as high as they are relative to DeFi rates, funds and bills have begun to make their way on chain, which is super duper exciting. And I'm a huge fan of Superstate. They're a tokenizer founded by Robert Leshner. He is the galaxy brain behind Compound Finance. He saw where all of this is going, and they are now the fourth largest treasury tokenizer by total assets under management. And they take a asset-based tokenization thesis, which is very exciting. Ultimately, it means that if you go through the KYC AML process, you can then custody the asset. You can transfer it to any counterparty that as well has undergone that KYC AML process and is approved to take custody of that asset. And that's from their USTB or USDT, excuse me, one of the two funds. You can check it out over on their site and their documentation now. So really, those two, stablecoins and treasuries, have had the most voluminous impact in terms of volumes and inflows. But one of the ones I'm most excited about, and I have to give a shout out to my friends over at Uranium 308, they are tokenizing uranium. Yes, the underlying yellow cake itself. And you can take physical delivery. And this is not a gimmick. You cannot actually take physical delivery at your home. Your crazy neighbor's not going to build a warhead off of it. You have to go through the very, very, very long, arduous process. And what's really exciting about this is the fact that uranium doesn't even have a spot market. It is very much the people who are digging it out of the ground have a contract with the people who will be using it. And what that means is that there's huge price disconnect in terms of what this stuff is actually worth. There's no market in order to speculate on the underlying value and create a liquid market for what the price should be day to day. So what they're doing is they're actually allowing the uranium market to leapfrog even Web 1 and Web 2 markets and straight into the Web 3 tokenization kind of flare. And what that means is that uranium, for the first time, is going to have a spot market, and it's going to be on tokenization rails, which is quite exciting and just in time for the energy transition. So looking forward to that.
Absolutely. And I think when people hear, oh, uranium, they're going to think, what are kind of the regulatory guardrails and what's kind of the regulatory landscape for real world tokenized assets?
Absolutely. For tokenized uranium, yes and yes. Of course, like I mentioned, your neighbor who doesn't like you is not going to be lobbing Fallout 4 style warheads over your fence anytime soon. There's a huge amounts of stipulatory components that go into taking custody of any kind of yellow cake, tokenized or not. But of course, they're playing by all the rules. For every, let's say, 80 tokenization projects that are potentially selling you a tokenized bridge, which may or may not be underwater already, there are 20 that are doing some very solid, compliant, by the book work, because it is a very heavy lift. Ultimately, it depends on the asset class we're looking at. As I mentioned, over RWA World, we have 13 taxonomical categories by which we define what tokenization activity is occurring in what asset class. And for collectibles, for example, the regulators are not going to come knocking at your door and saying, hey, we heard you had a 1981 transformer you're thinking about putting on chain. We'd need to see that item, please. That's totally fine. If they do, then you got some problems. However, if you're going to be tokenizing real estate, then there may be some potential issues. For example, if you're doing that in the United States. I mentioned Lofty. They're using a very unique approach, using a Wyoming DAO LLC. I highly recommend checking them out. It's fascinating. If you're a tokenization nerd like myself, you will love it. But ultimately, it really depends on the asset class. So treasuries as well. Those are highly regulated. Ultimately, the only ones that are doing it are funds that then allow for, at this stage, non-U.S. investors to take exposure to those type of underlying assets. Same thing with funds like themselves, like actual like equity funds. Those are very regulated. As I'm sure you know, Jack, you can't just go out and say, I'm going to start a fund, me and my buddy, and we're going to do it. And, I think we're going to do it with about $20,000, and I think we'll have it done by next Thursday. Doesn't quite work that way. There's a lot of regulatory stipulations you have to abide by. So it's very, very dependent on what asset you are tokenizing and kind of in what asset class that falls.
That makes a lot of sense. Now, are there any projects you see, because you do so much research, and are there any projects you're specifically curious about and you're really keeping an eye on?
Yes, absolutely. Of course, Uranium 308 is one, just because it's just so darn cool. It's something that's very exciting to me. As well, there's a company called Emocrypt here in the United States, which is tokenizing ammunition. And that's a very, very interesting one. There's a lot of supply and demand disconnects for ammunition specifically. And ultimately, they're guys with backgrounds in the defense industry. For anyone here in the United States who has a firearm, was interested in purchasing ammunition during the COVID-19 outbreak, there was lines to purchase the two amounts of cases you were willing to get. And there's really no way to have these things ultimately custody for you. There are some ways to do it, but really telling your bank, hey, hold on to all this 9mm ammunition is one, Mondo suspicious. And two, I'm not even sure if they do that. I never thought to ask, nor would I ask. Ultimately, gun owners have these sorts of things held in safes in their home or at a friend's house or what have you, and it's just kind of sitting there latent. So by not having to take physical inventory of this asset, then ultimately tokenization can allow for a lot more natural price discovery, remove some of those supply runs, you could say, whenever things do get kind of wonky. That's a very interesting sector overall. And ultimately, this is if you love guns or to test guns, it's nonetheless an asset class that's super neat to keep an eye on. And additionally, I'm big fans of a company called Unlocked. They are very focused on taking tokenized assets and allowing you to take a loan against a tokenized asset that is approved and compliant and assured to be with a approved custodian. For example, if you say, hey, I have a tokenized bridge, for sure, let me get a loan against that. They're not going to give you a loan against your potentially underwater tokenized bridge. But if you have it custodied with one of their approved custodians, you can take a loan against that physical asset on chain. And that what I like about Unlocked is they are really speaking to and building at the forefront of the interpolation between the traditional financial and the decentralized financial realms that we're seeing slowly but surely overlap. So those are three just off the cuff that I find really interesting. I've spoken to the teams. They're really stalwart, hardworking folks doing everything by the book. And ultimately, that's something to look for when it comes to tokenized real-world assets. CoinGecko recently had a report that said RWAs were the second most profitable narratives after meme coins. AI was a close third, but ultimately narratives are narratives. And while meme coins, they come and go, these tokenized assets are here to stay. And so it's really important to make sure that the underlying assets themselves are indeed extant and they really are custodied with a compliant custodian. We're really seeing that kind of emerge at the forefront because DeFi really hasn't always been the most regulated. TradFi, sometimes some can argue, is a bit overregulated, and it seems like we're beginning to meet in the middle, albeit with securities laws dating back to the 1930s, but I don't want to open that can of worms.
Yeah, there are so many exciting projects. Now, one thing we notice in technology is often sometimes the more developing markets. So if you went to Asia, for example, you might have seen that they adopted mobile payments a lot faster than the US. Are we seeing that asset tokenization is still largely in the United States, more the developed markets, or are we seeing more adoption in developing markets?
Fantastic question. A little bit of both. Definitely a lot of the drama for tokenizations happening in the United States jurisdiction. We just saw Congress approve the striking down of SAP 121. The president saying he may veto it. Wait till the next episode to see what actually happens. Ultimately, the United States has the most liquid and the most mature markets in the world. However, they are grappling with how to interpolate this new wave of technology into the existing financial system. And you're spot on. Developing markets are the ones that are really sort of taking the lead on testing the waters with how this sort of thing will work. Surprisingly, Switzerland has tokenized hundreds of millions of dollars worth of bonds, and these are all institutional grade bonds focused on central banks and financial institutions, large banks, in terms of how to tokenize these bonds to make for faster settlement. So they're really leading the way. Germany has come out very strong as the second largest jurisdiction for tokenized assets in terms of numbers of companies domiciled there. This doesn't speak to the total assets under management. There's just numbers of companies domiciled. And that's because Germany has ultimately issued and I'm not even going to try and say it as a word about this long in German, but it complies with the recent MiCAR legislation that was passed by the EU. And so there's a lot more compliance that's happening in Germany in terms of regulatory clarity. So we're seeing a lot of companies take domiciliation there, as well as Singapore. Of course, Singapore has Project Guardian. That's very much a government level tokenization initiative that's been ongoing since I believe 2019. And then Hong Kong has just come out swinging as a heavyweight in tokenization. Just fascinating stuff. They passed the world's second Bitcoin ETF, the world's first Ethereum ETF. They allow retail investors to purchase tokenized gold custodied in the HSBC London vault. They're experimenting with, of course, ECNY, which is the tokenized Chinese yuan. They've now interpolated that into their jurisdiction. And reasonably, what we've seen is a lot of Chinese citizens who are converting near immediately their tokenized Chinese yuan out of tokenized yuan, which should spell disaster, but it's just because it doesn't pay a yield. And that's what Hong Kong is actually working on now. So they have been very quick on the draw to take these kind of developments, improve upon them, and ultimately create a regulatory framework that's making a lot of sense for these tokenized assets. So I'm a big fan of what Hong Kong is doing for tokenization, along with all of the jurisdictions that I mentioned, and fingers crossed for a bit of regulatory clarity here in the good old US of A.
And I think a lot of people are probably wondering, okay, if this is nascent technology, but let's look 10 years into the future and kind of speculate. What does this mean for everyday people? What does this mean for financial institutions, government agencies? Like, what will the future look like with these new tokenized assets?
Absolutely. And fantastic question. I very much hope that at least here in the United States, we have some kind of new regulating body that is separate from the CFTC, separate from the SEC or any of the alphabet soup government agencies that we have currently that would preside over these kind of tokenized assets. Realistically, I mentioned securities laws dating back to 1933 and 34. Part of the reason we don't have onion futures in this country, if you look at the Onion Futures Act of 1954, I believe, it's a hilarious story. The rivers ran red, not with blood, but with onions. Wild times. But ultimately, the world has kind of moved on from there. Now, I think you can still get that many onions in a river. I don't think that's fundamentally changed, but technology certainly has. And what that means is that 10 years in the future, if the United States can get a bit of its act together with its incredibly liquid and mature markets, its huge consumer base, its fantastic demographics relative to the rest of the developed world, that can make a huge, huge difference in terms of the regulatory regime that we see here in the US. And it could very much capitalize on the fact that it has around 35% of all tokenized asset companies in terms of count. Again, this doesn't count assets under management. Now, ultimately, I think jurisdictions like Singapore, jurisdictions like Germany, they're going to try their best to continue to capitalize on this kind of beleaguered status we're seeing in the US. So 10 years down the road, the European Union has a bit of an ongoing meme in terms of, well, they don't innovate, they regulate. But realistically, and this doesn't count trusts and other kinds of similar configurations that can ultimately custody digital assets, looking at Fireblocks and those sorts of things. Just looking at a bank-to-bank ratio, so I wanted to preface with that as to not make it too misleading. For every $1 in US banks specifically, there's $350 in your EU banks. And so if this trend continues, then ultimately the European Union could well become the asset hub for where people custody these assets. And that could really make all the difference, because keep in mind, Ethereum got started in Germany, it got started in Berlin. A lot of people kind of forget that fact. And as well, we're talking about physical things here. Apply $735,000 big pen, which it's not, this came out of one of the 10 backs. If it's custodied in a vault in Germany, let's say, and the company is based in Germany, or let's say the other way around, the company's in Germany, it makes sense for the vault to be in Germany, they begin to start to have a bit of a runaway market share. So ultimately, 10 years down the road, it's anyone's game, but we're seeing the early foundation being laid for who's going to be the leaders and then runners in this race, ultimately, who may have the ability to pull ahead. It's not de facto the United States, it's anyone's game still.
Yeah, I think it's a very exciting future. And I do want to give you some more time to talk about your project, what you guys are currently working on. What does success look like for your project?
Absolutely. So success for RWA World is when you think of real world assets, you think of RWA World. Really, that is the measure of success. We seek to be a definitive source of truth, not the definitive source of truth, but one of the definitive sources for truth for real world assets. Think of like a Bloomberg or a Morningstar almost. For when you access real world assets, you want to make an apples to apples comparison. You want to get a better idea of what you're looking at in terms of how these could fit into your portfolio, how to even begin to structure a portfolio of tokenized assets. So, hello, I'm American. Can I even get access to some of these tokenized assets? Maybe, maybe not. But we want to help everyone everywhere make those determinations in the ways that make the best sense for them. So right now what we're doing is we're building out the technology to make that happen. We have fantastic relationships with the almost 400 tokenized asset initiatives that we have in the largest publicly available database for RWA's tokenized assets over at RWA World. You can go check those out. And with those fantastic relationships, we're beginning to see what these companies need, and of course, what investors need to make these determinations and connect these two parties in ways that make the most sense. Kind of threading back to something I mentioned earlier in this conversation, the 0 to 1 educational component is so huge. All the questions you asked, Jax, are just like so on point in terms of demystifying some of these things, some of these concepts that are very nascent and very unfamiliar for folks, but still somehow makes sense. They have a bit of a ring of familiarity. And going back to my father-in-law, he said, "Oh, okay, it's just a better way of tracking assets I'm familiar with." Okay, we're getting somewhere now, rather than, "Oh, it's a coin that lives on a blockchain. What's a blockchain? Don't worry about it. How do you get it? Oh, we run computers." Okay, we're talking Star Trek, and we've lost them. So ultimately, RWA World is made to have those 0 to 1 educational aha moments in a bit of a matrix. And wherever you may find yourself in your journey of tokenized assets, we have something for you. And ultimately, we serve to be the kind of a Rolodex of high fidelity real world asset companies, initiatives, projects, etc., for being the front page of RWAs. That's RWA World.
That's very exciting. Are there any specific milestones they should be looking forward to in like a month, 3 months, 12 months that you guys are hoping to roll out?
We absolutely have some very exciting things. I think my co-founder Tyler would be kind of throwing things at me if I let too much slip. But suffice it to say that we have some very exciting partnerships in the works, and a couple of them. We are potentially looking at some things in terms of being able to scale up our operations by orders of magnitude that are in the works currently. Very exciting conversations with some very big names that you all know. They're household names in the world of tokenization and financial industry. Can't say more than that. I would really like to, and I feel it kind of trying to jump out of the back of my mouth. So I'll very quickly.
All good. All right. So if there are any, let's say, devs in the audience, some developers, are there any kind of problems that are existing in the real world asset space right now that if you had development resources, you would say, hey, go fix this?
Absolutely. If I'm talking to the devs, hello, shadowy supercoders, you guys are so cool. I am just a humble researcher and I can write in English. That's what I do. You guys speak to the machines and they speak back to us now, which is crazy cool. Ultimately, one of the things we see that is most needed is modularization and formalization of how these assets are coded in terms of their metadata. It's a huge problem that we're solving. It's a huge thing that's just out there in general. It's pretty clear to see that, hey, if you have a tokenized bond, it's not going to be the same as a tokenized watch. Hey, if you have two companies that are tokenizing Pokemon cards, they may not use the same tickers and codes and all the nice things in their metadata. But that's a really cool idea. It's a very cool thing that we're really at the forefront of. And ultimately, if you are working on these kind of tokenized asset projects, it's something to keep in mind that if you're building your own tokenized regime, maybe start just like we did with our taxonomy, right? We have a proprietary taxonomy, and it's very quickly becoming one of the de facto lenses through which people view these tokenized assets. If you have development resources and you're out there, one, give us a call. We'd love to collaborate. It's a very small industry. And two, ultimately, if you're going to be undertaking a tokenization initiative, start thinking early on about how you would like to codify these sorts of things with whatever types of assets you may be touching. Just as a word of advice, having been so deep into the weeds of tokenization now for going on a year, well, longer than a year if you count my foray into carbon credits. Really been a tokenization there at heart since I learned about Bitcoin. But is that a token? Is that a coin? That's an ongoing debate. I'm not going to open that can of worms, but that's definitely what I would recommend for our developer friends out there.
All right, very interesting. So if there are any devs in the audience, please do reach out. So are you guys looking to hire right now? Are you looking for any kind of help? So if we have some incredible marketers or anyone in the audience, is there anything that RWA World is looking for right now?
Yeah, so we actually help to run Wolf Web3, one of the largest Twitter space company currently. They have about 60,000 people on a weekly basis who move through their Twitter spaces. We're incredibly close with them. And so in terms of the marketing side, we are pretty well set there. We're not hiring currently, but we will be in the very near future. TM, that's not my department. I am just a humble researcher and writer. I do the ticky-tacky on the keyboard. But nevertheless, we're always looking for help to build this sort of world. I like to say we don't have competitors, we have contemporaries. We're at such the early days for tokenized assets that ultimately you could probably count all the companies that are building at the forefront on 4 hands. I only have 2, but yeah, it's probably only 20 or less that are ultimately building at the forefront of this kind of thing. So while we're not hiring right now, definitely we're building huge relationships. Like I said, we have 400 tokenization initiatives in the database. We've talked to the majority of them now. So definitely reach out. We'd love to have these conversations. I'm pretty much an open book when it comes to discussing these sorts of things, sharing information, collaborating. It's a collaboration. We're trying to win against the extant inefficiencies of the existing financial industries. That's kind of where we're at.
Absolutely. Thank you so much, Ray. And where can listeners go to find more about you? You talked about the Wolf Web3 spaces. Is there any place else, any kind of social media you want to shout out?
Yeah, for sure. Definitely check us out at rwa.world. You can find all of our stuff there and subscribe to our newsletter. We have a weekly newsletter that comes out every Friday. We really give everyone the finger on the pulse of tokenization. We cover all the news, all the happenings. You can listen to the recording of the previous days Wolf Web3 space. And that's really where all the information lives currently, is the newsletter. And as well on Wolf Web3 and RWA World Twitter, you can find all of the updates that are happening. We try to stay on top of really by the day, sometimes by the 48 hours if we're a little bit slow, as to the happenings in the world of tokenization. So definitely check us out there. And on LinkedIn, as you can tell, I'm not as much of a black tie kind of guy. That's Tyler's department. But LinkedIn, we're starting to up our game there.
Perfect. Well, connect with Ray on social media. I'll put all of the links into the bio. And this was another episode of Building Web3. Ray, thank you so much for coming.
Jax, thanks so much for having us. And let's keep building Web3 in the future of finance.